Good afternoon. The International Monetary Fund says South Africa's economic recovery remains fragile and growth is expected to hold below 2% in the medium term because of policy uncertainty, high public debt and constraints on investment. In a statement issued at the end of the discussions with South Africa, the IMF says the country's recovery from the COVID-19 pandemic had been faster than expected, but its durability remains uncertain. Economic growth is projected at 1.9% this year after an estimated 4.6% rebound last year. The fund projects 1.4% growth over the medium term. The fund says the economic recovery is fragile as it is accompanied by worsening unemployment and the weak bank lending to the private sector. Now let's have a look at what's happening from a markets perspective. Shares in Asia declined as investors in the region reacted to the release of a hotter than expected US CPI report that pushed the 10-year Treasury yield past 2%. Mainland Chinese stocks closed lower. Hong Kong's Hang Seng Index declined 0.25% as of its final hour of trading. Risk sentiment was then further dampened when St. Louis Fed President James Bullard, who acknowledged that the reading had rendered him dramatically more hawkish. Bullard said he's now hoping for a full percentage point of interest rate rises in the first half of the year. To talk to us about how all of this is affecting our local markets, but also to digest that US CPI number, we are joined by Jones Gondo, who is a research analyst at Nedbank CIB. Jones, thank you so much for your time. Before we get into the aspect of that US CPI figure, how's our JSE market reacting to what happened in Asia and also what's probably happening right now in Europe?
Hi, good afternoon. I think all markets are on the back foot. Certainly we're down this afternoon. I think we are digesting it because I think it really indicates that the rate hiking cycle for the US is now a dead cert.
I'm curious, what's been interesting for you when you look at the market right now, whether it's today or even when you look back at the past week? What stood out?
Look, I think this inflation print was something that stood out. This week was really quiet in terms of corporate earnings reports. I think the one that did stand out right at the beginning of the week was Telkom's results, which were third quarter wasn't as bullish and as good as the market expected. But in general, I think everyone in the market today at least was overshadowed by the global macro environment as opposed to perhaps domestic sentiment that perhaps after Asona, which we think was at least its tone was fairly positive, but that's not what's pricing into risk assets today.
Right, so let's get into that US CPI figure. I mean, hotter than expected. And then you have these comments from the Louis Fed president saying that he would like to see 100 basis points of hikes by July. How do you think the Fed is going to be digesting all of this going into their March meeting, given that between now and that March meeting, we've got one more CPI print that we are expecting? So what are you looking out for?
Yeah, look, I think the economy is running hot. It's at a full employment and also growth has been fairly robust. So I think it's for us, we're saying it's a dead cert that they will commence with their rate hiking cycle. But Fed President, St. Louis Fed President Bullard is only one member and he's changed his mind. Others have come out voicing saying, look, we're not going to overreact, because I think if you think of the longer term throughout the rest of the year, they need to use the space to anchor expectations a lot lower. And they also are going to start tapering their balance sheet purchases. So, that has an implied impact of tightening financial conditions, which is like adding an extra hike in it. So I think in terms of timing, they don't necessarily need to go a 50 basis point start. I think they would start at 25 and then take the rest of the slack via their balance sheet tapering.
How would you describe the bond market right now in one word, and why would you use that word?
I think it's the one word would be uncertain. The reason why I'm using that word is because for our domestic curve, we are seeing that the bonds have been, despite all this global sentiment, have been uncharacteristically stronger. There's been buying of long-end bonds by local investors, meeting the sell-off by international investors. But I think in general, it's we would expect a much steeper curve out of South Africa, being one of the sort of emerging market proxies that gets hit by international sentiment quite viciously. And so it's holding up, but we are starting to see in this afternoon's trade, as the America sort of wakes up to their own news, that there is some weakening buy starting to feed into it. So it's been a difficult one to kind of see conviction through it.
In this current environment, and probably the environment we might see ourselves in the next 3 to 6 months or so, given how the rate cycles will probably play out, where does cash fit in someone's portfolio right now?
Look, cash in a rate hiking cycle, you tend to look at it as more as something you use for tactical use over the short term. As the cycle goes in, your typical inflation hedge stocks don't always perform as greatly because interest rates are going up at the same time. So I think it is a tactical asset used to find value as the base rates and asset prices begin to re-rate. So that's how I would use the cash allocation portfolios at this point in time. It's just a deferred tactical allocation for later.
All right, Jones, let's leave it there. Thank you so much for your time. That is Jones Gondo, who's a senior research analyst at Nedbank CIB.